It is completely legal to take a hospital's budget and hand it to a billionaire. Here's the paperwork that makes it legal. Every heist needs a vault and a crew. The vault this time is the US Treasury, and I'm about to show you 3 crews to crack it open. Path 1, the straight shooter. Make the team pay its own way. Path 2, the forger. Disguise the team's payment as a public tax. Path 3, the mastermind. Give the team the building for free and send taxpayers the bill for 90%. One of these gets audited into oblivion. One gets laughed out of the bond market. One built a $6.2 billion franchise out of a $250 million check. You just picked a crew in your head. Good, because by the end of this video, I'll show you exactly which one wins and prove it's still winning right now in 2026. To understand the heist, you have to meet the man who accidentally wrote the instructions. Senator Daniel Patrick Moynihan, 1986. He looks at the tax code and sees a scam. Cities issuing tax-free bonds so a private football team can build a stadium virtually rent-free. So he writes a fix into the Tax Reform Act of 1986. Section 142. Sports facilities get pulled off the list of bonds that qualify for automatic tax-exempt status. From here on, a stadium bond only stays tax-exempt if it qualifies as a governmental bond under Section 103A instead. And that means passing 2 tests, both written into Section 141 of the tax code. Test 1, the private business use test. Is more than 10% of the building used by a private business? A professional sports team sitting there as the exclusive tenant for 30 years? Obviously, yes. This test is basically unpassable. Every stadium fails it automatically, which is exactly why Moynihan built a second one. Test 2, the private payment test. Does the team cover more than 10% of what it costs to pay the bonds back? Fail that too, and the bonds lose their tax break. Simple, clean. Should have killed stadium subsidies dead. It didn't kill anything. It just told every bond lawyer in America exactly which number to stay under. 10 years later, Moynihan realized what he'd built and tried to blow it up himself. He failed. We'll come back to that. Here's the play, step by step. City wants a stadium. Team threatens to leave if they don't get one. So the city issues, let's say, $900 million in bonds and structures the team's lease at $1 a year. Not a typo. $1. Because the team's payment is basically zero, it can never cross that 10% threshold. The bonds stay tax exempt. And because none of the team's revenue is going toward the debt, none of it counts against the test. So the team keeps 100% of the naming rights, the suites, the parking, the concessions. So who pays the other 90%? You do. Hotel taxes, rental car surcharges, sales tax hikes for 30 years. You've seen how the trick works. Now watch who actually pulled it off first, because it's not who you'd guess. 1989, Baltimore. The Maryland Stadium Authority needs to fund Camden Yards without the Orioles paying real rent. Their move: cover the debt with state lottery revenue instead of team revenue. Lottery cash is public money, so the private payment test never even gets close to failing. This becomes the blueprint every city copies next. 2009, the Bronx. The deal itself was built years earlier, bonds structured, lease signed back in 2006 and 2007 for a stadium that wouldn't open until 2009. The trick? Payments in lieu of taxes pilots, routed through a city agency to cover $942 million in tax-exempt bonds. But there's a catch in the Treasury rules. A pilot only escapes the private payment test if it's equivalent to and doesn't exceed what the property would owe in ordinary taxes. Set it at a number just high enough to match the debt payments, and it's not a pilot anymore. It's a taxable special charge. So New York needed a property assessment big enough to make the math work. The city's Department of Finance skipped the comparables in the South Bronx, one of the poorest districts in the country, and pulled its numbers from 8 parcels in Manhattan instead. In a single day, the land assessment jumped 600% to $204 million. The IRS signed off. A year later, in October 2008, the IRS shut this specific move down for future deals. The Yankees deal and the Mets and Barclays Centers got grandfathered in anyway. They kept the savings. 2020, Las Vegas. The Raiders in Clark County run it at full scale. Public bonds fund the bulk of the build. A hotel tax under 1% covers it. Owner Mark Davis puts in $250 million of his own money and keeps every dollar of naming rights worth over $20 million a year forever. 3 cities, 3 decades, same exact play. Here's the part that isn't a highlight reel. Brookings put a number on this. Since 2000, federal taxpayers have subsidized stadiums to the tune of over $3 billion. And once you count what high-income bondholders save on their own taxes, the real hit to the Treasury tops $3.7 billion. Hamilton County, Ohio had to sell a public hospital to cover the shortfall on the Bengals stadium debt. Cobb County, Georgia pays $10 million a year every year for 30 years for the Braves, and has cut library budgets to do it. When the Raiders left Oakland for Vegas, they left behind $80 million in debt from a stadium renovation the team wasn't even playing in anymore. And economists, real ones, not team-hired ones, have checked the actual growth numbers for decades. Dennis Coates and Brad Humphreys, who've studied this longer than almost anyone, found the same thing again and again. Stadiums don't create new economic activity. They move existing spending from one part of town to another, while the debt stays exactly where it is. Congress has tried to kill this loophole 4 separate times. Moynihan himself in 1996, the IRS in 2006, the 2017 tax bill, a bipartisan bill in 2023. Every single time, league lobbying got the fix stripped out or buried in committee. So, remember the crew you picked at the start? If you picked the mastermind, the 90-10 play, you were right, every time. It's the only structure that survives contact with the actual tax code, because it's the only one built to legally fail the test on purpose. And here's the twist this loophole doesn't want you to know. This isn't old news. This month, June 30th, 2026, the House Ways and Means Committee held a 4-hour hearing on exactly this. Lawmakers on both sides pointed out that 43 of the last 57 stadiums were built with tax-exempt bonds at a cost of $4.3 billion. And in 7 of those cases, the team left anyway, leaving taxpayers holding debt for a team that isn't even in town anymore. Congress talked about fixing it again, just like 1996, just like 2006, just like 2017. And the loophole is still sitting right there, waiting for the next city to walk through door 3. So here's my actual question for you. Not a hypothetical this time, a real one. If you were the mayor and the team threatened to leave, would you take the deal? If this is the first heist you've watched in this series, the next one's bigger. How one tax rule turned professional sports franchises into the most tax-advantaged asset class in America. And why billionaires would rather own a team that loses money than one that wins. That is the next video.